Finding a genuine growth stock trading at a value price is the holy grail of investing. It happens rarely because markets are reasonably efficient. When a company is growing rapidly, investors usually recognize that growth and bid the stock up to reflect future potential. When a stock is cheap, there is usually a good reason. The business might be in decline, the industry might be facing headwinds, management might be terrible. Rarely do you find a business that is genuinely growing, has good fundamentals, and is trading at a price that does not reflect that growth. But when you do find this combination, when you find a true growth stock at a value price, the returns can be extraordinary. Today, I am going to share 3 stocks that I believe represent this rare opportunity. These are businesses with genuine growth prospects, strong competitive positions, and reasonable or even cheap valuations. The market is mispricing them for reasons I will explain. And if I am right, each of these stocks could double or triple over the next 3 to 5 years. These are not recommendations. I am sharing my analytical framework and my current thinking. You need to do your own research and make your own decisions, but I believe these 3 opportunities represent some of the most attractive risk-reward in the market today. Before I reveal these 3 stocks, let me tell you about the best growth at value investment I ever made because it shaped how I think about these opportunities. In 2006, I invested in Target. At the time, Target was trading at around $50 per share with a market cap of about $40 billion. Most investors thought of Target as a mature retailer with limited growth prospects. The stock traded at a modest valuation, maybe 15 times earnings. But I saw something different. I saw a company that had barely penetrated many geographic markets. I saw a brand that resonated with customers in ways that competitors could not replicate. I saw operational improvements that could drive margin expansion. I saw a management team that was making smart decisions about store formats, merchandising, and customer experience. In other words, I saw a growth company that the market was treating as a value company. Over the next several years, Target proved my thesis correct. They expanded into new markets successfully. They improved their operations and margins. They built out their online capabilities earlier than most retailers. The stock went from $50 to over $70. I eventually sold as the growth story matured and the valuation expanded. But that investment taught me to look for situations where the market is missing growth potential, where investors are so focused on near-term challenges or industry headwinds that they fail to recognize genuine long-term growth opportunities. That is where you find growth stocks at value prices. And that is what I am looking for in these 3 opportunities I am going to share. The first stock is Meta Platforms, the company formerly known as Facebook. I know what you are thinking. Meta is one of the largest companies in the world with a market cap over $1 trillion. How can that possibly be a value stock? But hear me out. Meta is trading at around 23 times earnings. For a company growing revenue at double-digit rates with 40% operating margins and massive optionality in artificial intelligence, that is cheap. Let me walk through the thesis. Meta has 3 billion daily active users across Facebook, Instagram, WhatsApp, and Messenger. 3 billion people. That is an audience larger than any media company in history. They monetize that audience through advertising. Advertisers pay Meta to show ads to users based on detailed targeting. This business model has been extraordinarily profitable. Last year, Meta generated over $40 billion in operating income on about $135 billion in revenue. 40% margins in an advertising business. That is exceptional. The bear case on Meta has been consistent for years. Privacy regulations will limit their ability to target ads. Apple's iOS changes already hurt their ad targeting. Users are shifting time to TikTok and away from Facebook and Instagram. The metaverse investment is a waste of money, burning tens of billions with no return. All of these concerns have some validity, but I believe the market is overweighting the negatives and underweighting the positives. Let me address each concern. On privacy and ad targeting, Meta has adapted. They rebuilt their ad system to work with less data. They focused on platform conversion rather than tracking across the web. And guess what happened? Ad revenue is growing again. Advertisers are getting good returns on ad spend. The iOS changes hurt temporarily, but Meta figured out workarounds. They are more resilient than the bears believed. On competition from TikTok, Instagram Reels is working. They copied TikTok's short-form video format, and users are engaging. Reels now drives significant usage on Instagram. Meta is not losing users to TikTok. They are competing successfully, and they have advantages TikTok does not have. They have better monetization infrastructure. They have better advertiser relationships. They have multiple properties, so if users shift from Facebook to Instagram, Meta still wins. On the metaverse, I actually think the investment makes sense long term, even though the near-term losses are painful. Mark Zuckerberg is betting that augmented and virtual reality will be major computing platforms in the future. He is investing early to establish leadership. The spending is around $15 to $20 billion per year. That sounds like a lot, but Meta generates over $40 billion in operating income from the core business. They can afford to invest in the future. And if the metaverse becomes a major platform, Meta will be positioned to dominate, just like they dominated social media. But here's what the market is really missing. Meta is in the early innings of monetizing artificial intelligence. They have more data on human behavior than any company in history. Billions of people sharing what they like, what they click on, what they buy, what they talk about. That data trains AI models. Meta can use AI to improve ad targeting, to create better content recommendations, to automate customer service, to build new products. The AI opportunity is massive, and Meta is one of the best positioned companies to capitalize on it. They have the data, the talent, the infrastructure, and the capital to lead in AI applications. Yet the stock trades at 23 times earnings, as if they are a mature business with limited growth. That disconnect is the opportunity. Here is my valuation case. Meta will generate around $150 billion in revenue this year, growing at 10 to 15% annually. Operating margins will expand from 40% to 45% as they optimize spending and leverage infrastructure. That implies operating income growing from $40 billion to $60 billion or more over the next 3 to 5 years. Apply a 25 times multiple, which is reasonable for a high growth, high margin, dominant business. That gets you a market cap of $1.5 trillion. Add in the optionality from AI and metaverse, and you could justify even higher. Current market cap is around $1 trillion. That implies 50% upside over the next few years, and the downside is limited. Even if growth slows to single digits and margins do not expand, the business still generates massive cash flow. The stock might not go up much, but it is unlikely to fall dramatically. That asymmetric risk reward, 50% upside with limited downside, is what I look for in growth at value opportunities. The risks with Meta are well known. Regulation could get more severe. European regulators are particularly aggressive. They could fine Meta or force changes to the business model. User growth could stall or reverse, especially among younger users. Competition could intensify beyond what I expect. The metaverse investment could turn out to be a wasteful distraction that never pays off. Management could make mistakes in capital allocation. These are real risks, but I believe they are more than priced in at current valuation. The market is assuming multiple negative scenarios simultaneously. That creates opportunity for investors who take a more balanced view. Let me dig deeper into why I believe Meta's competitive position is stronger than the market appreciates. The advertising business is fundamentally about return on ad spend for advertisers. If advertisers are getting good returns, they will keep spending money on the platform. Meta has consistently delivered strong returns for advertisers across multiple business categories. Small businesses use Facebook and Instagram to reach local customers cost-effectively. E-commerce companies use Meta's platform to drive sales with measurable conversion tracking. Large brands use Meta for awareness campaigns that reach billions of people. This value proposition has not changed despite all the challenges Meta has faced. Advertisers are still getting results. That is why ad revenue is growing again after the temporary setback from iOS changes. I have spent significant time talking to advertisers and marketing agencies to understand how they view Meta's platform. The consistent feedback is that Meta remains one of the most effective advertising channels available. The targeting might not be as precise as it was before privacy changes, but it is still better than most alternatives. The reach is unmatched. The creative formats, especially video and stories, drive strong engagement. The measurement and attribution, while imperfect, are better than traditional media like television or print. When I compare Meta to alternatives like Google, TikTok, Snap, or traditional media, Meta holds up very well on return on ad spend. That is the fundamental reason I believe the advertising business will continue to grow. On the user growth and engagement question, I want to address the concern about younger users. It is true that Facebook usage among teenagers is lower than it was a decade ago. Teenagers today prefer Instagram, TikTok, and Snapchat, but Meta owns Instagram. When users shift from Facebook to Instagram, Meta still wins. And Instagram is extremely popular with younger users. Instagram Reels, their short-form video product, has over 200 billion plays per day. That is massive engagement. Meta is successfully competing for attention even as user preferences shift. The key metric is not whether people use Facebook specifically, but whether they use any Meta property. On that measure, Meta is doing fine. 3 billion daily active users across the family of apps. That number is still growing, albeit slowly, and engagement measured by time spent is stable or increasing thanks to Reels and other new formats. The metaverse investment deserves more discussion because it is such a large drag on current profitability. Meta is spending $15 to $20 billion per year on Reality Labs, the division responsible for virtual reality headsets and metaverse development. That spending reduced operating income by 15 to 20 billion last year. Without that spending, Meta's operating margins would be above 50% instead of around 40%. Investors hate this spending because it seems like a waste. The metaverse has not gained mainstream adoption. Quest headsets sell a few million units per year, a tiny fraction of smartphone sales. The virtual worlds Meta is building have limited users. Revenue from Reality Labs is negligible, maybe a few billion per year, nowhere near enough to justify the spending. But I take a different view. Mark Zuckerberg is making a long-term bet that the next major computing platform after smartphones will be augmented reality and virtual reality. He saw what happened when Facebook missed mobile. They were late to adapt to smartphones and had to scramble to rebuild their products for mobile. That mistake almost killed the company. Zuckerberg is determined not to make the same mistake with the next platform. He is investing early and heavily to ensure Meta has leadership if AR and VR become major platforms. Is this investment guaranteed to pay off? No. AR and VR might remain niche products for gaming and specialized applications. The mainstream might never adopt them for daily use. Zuckerberg could be wrong about the future of computing platforms, but the bet is not as crazy as it seems. Consider the smartphone transition. In 2007, Nokia and BlackBerry dominated mobile phones. Apple launched the iPhone. Most people thought it was an expensive toy. Within 5 years, smartphones had replaced traditional phones and created entirely new categories of applications and businesses. The companies that led in smartphones, Apple and Google through Android, captured enormous value. The companies that missed smartphones, Nokia and BlackBerry, were destroyed. If AR and VR follow a similar trajectory, the winners will capture trillions of dollars in value. The losers will be left behind. Zuckerberg is betting tens of billions to be in the winner's camp. Even if the probability of success is only 30 or 40%, the expected value could justify the investment. And there are signs of progress. Quest headset sales are growing. Developers are building more applications. The technology is improving with each generation. Headsets are getting lighter, more comfortable, more capable. Apple just entered the market with Vision Pro, which validates the opportunity. If Apple is investing in this category, it signals they see potential. Meta has a multi-year head start on Apple in terms of developer ecosystem and user base. They have sold tens of millions of Quest headsets while Apple is just launching. That installed base and ecosystem give Meta advantages if the market grows. I am not saying the metaverse investment will definitely pay off, but I am saying it is a rational bet for a company with Meta's resources and strategic position, and the market is penalizing Meta's valuation for this investment as if it has negative value. That creates opportunity. If the metaverse succeeds even partially, Meta's stock could be worth multiples of current value. If it fails completely, Meta can cut spending and return to 50% margins on the core business. Either scenario supports higher valuation than 23 times earnings. Let me also address the artificial intelligence opportunity in more detail, because I believe this is the most underappreciated aspect of Meta's value. Meta has been investing in AI for over a decade. They have world-class AI research labs. They have recruited top talent from academia. They have built massive infrastructure for training and deploying AI models. And most importantly, they have more data on human behavior than almost any company in the world. 3 billion people sharing, liking, commenting, clicking, watching, buying. All of that behavior trains AI models to understand what people want, what they respond to, what they will engage with. This data advantage is enormous and durable. Competitors cannot replicate it without building a similar scale social network. Meta is using AI across their products already. The ad targeting uses AI to predict which users will respond to which ads. The content recommendation algorithms use AI to decide what posts, videos, and reels to show each user. The moderation systems use AI to detect and remove harmful content. The search and discovery features use AI to help users find relevant content and accounts. All of this is generating value today. But the next wave of AI applications could be even more valuable. Generative AI could create personalized content for each user. AI assistants could help users plan trips, shop for products, find information. AI could enable new creative tools that make it easier for anyone to create high-quality content. AI could power better virtual and augmented reality experiences. The possibilities are vast, and Meta is positioned to capitalize on many of them. The market is focused on companies like OpenAI and Anthropic that are building foundational AI models. Those companies are getting astronomical valuations based on the promise of AI. But Meta has better data, more users, more distribution, and more resources than most AI startups. They can integrate AI into products that billions of people already use. They can monetize AI through advertising, subscriptions, and commerce. They do not need to build a new business from scratch. They can enhance and extend their existing businesses. That should be worth a premium, not a discount. Yet Meta trades at 23 times earnings, while pure-play AI companies trade at multiples of revenue with no profits. This disconnect is another source of opportunity. The second stock is Alibaba. This one is controversial because it is a Chinese company, and investors are rightly concerned about China risk. But the valuation is so compelling and the growth prospects are so strong that I believe the risk-reward is highly favorable. Alibaba is the Amazon of China. They operate massive e-commerce platforms, including Taobao and Tmall. They have a leading cloud computing business. They own a digital payments company, Ant Financial, that processes more transactions than Visa. They have investments in media, entertainment, logistics, and international e-commerce. This is a diversified internet conglomerate with dominant positions in massive markets. And the stock trades at around 10 times earnings, 10 times. For a company growing revenue at high single digits with substantial optionality in cloud computing and international expansion, let me walk through the asset value. The core commerce business in China generates around $100 billion in revenue with operating margins around 15%. That is $15 billion in operating income. At a 15 times multiple, that business alone is worth $225 billion. The cloud business, Alibaba Cloud, is the leading cloud provider in China and Asia. It generates around $15 billion in revenue, growing at double-digit rates. It is currently low margin because they are investing for growth, but eventually this business should have margins similar to AWS, maybe 30%. Apply a revenue multiple of 5 times like investors use for other cloud businesses. That is $75 billion in value. Ant Financial, even after the regulatory crackdown, is still an enormously valuable asset. They process transactions for hundreds of millions of users. Even if you assign a conservative valuation of $50 billion for Alibaba's stake, that is real value. Add in the international e-commerce businesses, the media investments, the logistics network, and other assets, you get to a sum of the parts valuation well over $400 billion. The current market cap is around $200 billion. The company is trading at half of asset value. Why is the stock so cheap? China risk. Investors are terrified of regulatory intervention. The Chinese government cracked down on Ant Financial right before its planned IPO. They fined Alibaba billions for antitrust violations. They have signaled that internet platform companies are not above regulation. Investors worry that the government could further restrict Alibaba's business or force divestitures or impose new regulations that hurt profitability. These concerns are legitimate. The Chinese government is unpredictable. The legal and regulatory framework does not provide the same protections as in the United States. As a minority shareholder, you have limited recourse if the government decides to harm the business. I am not dismissing these risks. They are real and significant. But I believe the market is overpricing the risk. The regulatory crackdown is largely over. The government has signaled they want to support the private sector and restore confidence in internet companies. They recognize that these companies are important for economic growth and innovation. The worst-case scenarios that investors fear, nationalization or destruction of the business, are extremely unlikely. China wants successful global companies. They want Alibaba to compete internationally. They want the tax revenue and employment that Alibaba generates. The more likely scenario is that Alibaba operates under more regulation but continues to grow and generate substantial profits. If that is the case, the stock is dramatically undervalued. Let me elaborate on why I believe the worst-case China scenarios are unlikely. The Chinese government's actions toward Alibaba and other internet companies need to be understood in context. In 2020 and 2021, these companies had become extremely powerful. They controlled vast amounts of data on Chinese consumers. They had significant influence over media and public opinion. They were expanding into financial services that could compete with state-owned banks. The government viewed this concentration of power as a potential threat to social stability and party control. The regulatory crackdown was designed to reassert government authority and ensure these companies operated within boundaries the party found acceptable. But the government never wanted to destroy these companies. Jack Ma's rhetoric about traditional banking being outdated probably went too far and prompted a strong response. But even at the height of the crackdown, Alibaba's core businesses continued operating. The commerce platforms kept processing billions in transactions. The cloud business kept growing. The logistics network kept delivering packages. What changed was the regulatory environment. Ant Financial had to restructure to be more like a traditional financial institution subject to banking regulations. Alibaba had to accept antitrust scrutiny and fines. The company had to be more careful about acquisitions and competitive practices. But none of this destroyed the fundamental value of the businesses. Since the worst of the crackdown in 2021 and 2022, the Chinese government has moderated its approach. They have publicly stated they want to support the platform economy and technology companies. They have approved new video game licenses, signaling support for the gaming industry. They have allowed companies like Didi to resume normal operations. They are trying to restore confidence in the private sector. This makes sense from the government's perspective. China's economy is slowing. Youth unemployment is high. The real estate sector is in crisis. The government needs private sector companies like Alibaba to drive growth and create jobs. Continuing to punish these companies would be self-defeating. I believe we have seen the worst of the regulatory risk, and the environment going forward will be more stable. That said, I am not naive about China risk. The government could change course again. They could impose new regulations that hurt profitability. They could force divestitures of valuable assets. They could restrict international expansion. The legal and regulatory framework does not provide the same protections as in developed markets. As a minority shareholder, I have limited rights and limited recourse if the government takes actions that harm my investment. This is why I would size Alibaba smaller than a comparable U.S. investment, but I think the probability-weighted outcomes are favorable. The base case is that Alibaba continues operating under increased regulation and generates strong cash flows. The downside case of serious government interference is possible, but probably low probability, maybe 10 to 20%. The upside case is that the stock re-rates significantly as China risk perceptions normalize. Balancing these scenarios, the risk-reward is attractive at current valuation. Let me also discuss Alibaba's business segments in more depth, because the sum of the parts valuation is compelling. The core commerce business includes Taobao and Tmall. Taobao is a consumer-to-consumer platform similar to eBay, where individuals and small merchants sell products. Tmall is a business-to-consumer platform where brands and retailers have official stores. Together, these platforms processed over $1 trillion in gross merchandise value last year. Alibaba earns money through advertising and fees paid by merchants. They do not take inventory risk or own the products. This capital-light model generates high returns. The commerce business generates around $100 billion in revenue with 15% operating margins. That is $15 billion in operating income from a durable, market-leading position. Even if this business does not grow, which is conservative given China's continued consumption growth and e-commerce penetration, $15 billion in operating income at a 15 times multiple is worth $225 billion. That alone is more than the current market cap. Everything else, cloud, international, logistics, media, is free. That seems irrational. The cloud business is particularly valuable. Alibaba Cloud is the leading cloud provider in China and across Asia. They compete with AWS and Microsoft Azure in serving Chinese and Asian companies. Cloud is still early in penetration in these markets. Enterprises are just beginning to migrate workloads to the cloud. Alibaba is well positioned to capture this growth. The cloud business generates around $15 billion in revenue, growing at low double-digit rates. Margins are currently low because they are investing for growth. But as the business scales, margins should expand toward the 25 to 30% that AWS achieves. A cloud business growing at 10 to 15% annually with potential for significant margin expansion over time should be valued at a meaningful multiple of revenue. Comparable cloud businesses trade at 5 to 10 times revenue. Even at a conservative 5 times multiple, Alibaba Cloud is worth $75 billion. Add that to the $225 billion from commerce and you are already at $300 billion in value. Then consider Ant Financial. Even after the regulatory restructuring, Ant operates the dominant mobile payment platform in China through Alipay. They process transactions for over 1 billion users. They provide consumer credit, insurance, wealth management, and other financial services. This is an enormously valuable asset. Alibaba owns 33% of Ant. Even valuing Ant conservatively at $150 billion, which is well below pre-IPO valuations, Alibaba's stake is worth $50 billion. Then you have the international commerce businesses, including Lazada in Southeast Asia, AliExpress globally, and Trendyol in Turkey. These are earlier stage, but growing rapidly. You have Cainiao, the logistics network that handles package delivery. You have the media and entertainment investments, including Youku Video. You have local services, including food delivery. Across all these businesses, there is easily another 50 to 100 billion in value. Add it all up, and you get to 400 to 500 billion in sum of the parts value. The current market cap is 200 billion. The company is trading at 40 to 60 cents on the dollar of intrinsic value. That is a massive discount. Why does this discount exist? Pure China risk. Investors are so afraid of what the Chinese government might do that they are discounting the value by half. That fear creates opportunity. If China risk is lower than the market fears, if the government allows Alibaba to operate normally and grow, the stock should re-rate significantly higher. Even normalizing to trade at just 80% of fair value would be 60% upside from current levels. And if China risk perceptions fully normalize, the stock could be worth double. That asymmetry is attractive. Here is my base case. Alibaba grows revenue at 8 to 10% annually over the next 5 years. Margins stay roughly flat or improve modestly as cloud scales. They generate around 25 billion in operating income within 5 years. Apply a 15 times multiple, which is still conservative for a business with these characteristics. That is 375 billion in value. Add in the value of assets like Ant Financial, and you get to over 400 billion. From a current market cap of 200 billion, that is 100% upside. And this assumes no multiple expansion, no major growth surprises, no AI breakthroughs, just steady execution in a business that continues to have dominant market positions. The downside case is that China risk proves worse than I expect. Regulation gets more severe, the business is restricted. In that scenario, the stock could fall another 30 to 40% from current levels. But I believe that scenario is low probability. The risk reward is heavily tilted toward the upside. I am sizing this position smaller than I would for a comparable US company because of the China risk. Maybe this is a 5 to 10% position versus 15 to 20% for a domestic company with similar characteristics. But even at a smaller size, if the investment works, it will be a meaningful contributor to returns. And the valuation cushion provides downside protection. At 10 times earnings, much of the bad news is priced in. The stock is not going to zero. The business generates too much cash and has too many valuable assets. The question is whether it trades at 10 times earnings or 20 times earnings over the next few years. I believe it will move higher as China risk perceptions normalize and investors recognize the value. The third stock is Booking Holdings. Booking operates online travel agencies, including Booking.com, Priceline, Kayak, and OpenTable. They are the largest online travel company in the world, with particular strength in international markets. The pandemic devastated the travel industry. Booking's revenue fell by over 50% in 2020. The stock fell from over $2,000 to under $1,000. But travel has recovered. People are traveling again, both for business and leisure. Booking's revenue has not only recovered, but exceeded pre-pandemic levels. Yet the stock trades at around 18 times earnings. For a business with these growth prospects and competitive position, that is cheap. Let me explain the business model. Booking acts as an intermediary between travelers and hotels or other accommodation providers. Travelers search for hotels on Booking.com. They book and pay through the platform. Booking takes a commission, typically 10 to 15% of the booking value. This is a beautiful business model. Booking does not own any hotels. They do not take inventory risk. They do not have capital tied up in real estate. They are purely a platform connecting supply and demand. The marginal cost of an additional booking is essentially zero. So as the business scales, the incremental margins are very high. This has allowed Booking to generate operating margins around 30% with very high returns on invested capital. The competitive advantage comes from network effects and scale. Hotels list on Booking because that is where the travelers are. Travelers use Booking because that is where the hotel inventory is. This creates a self-reinforcing cycle. As the largest platform with the most hotels and the most travelers, Booking has advantages that smaller competitors struggle to replicate. They can invest more in marketing to acquire customers. They can invest more in technology to improve the user experience. They have better data on pricing and availability. These scale advantages have allowed Booking to maintain market leadership for over 2 decades, even as competitors like Expedia and Airbnb have tried to take share. The bull case on Booking has several elements. First, international travel is still recovering. Many markets, particularly in Asia, have only recently reopened fully. As international travel normalizes, Booking will benefit because they are particularly strong in international markets. Second, the shift from offline to online booking continues. Many travelers, especially in emerging markets, still book travel through traditional travel agents or directly with hotels. As these travelers move online, Booking captures that shift. Third, alternative accommodations like vacation rentals are growing faster than traditional hotels. Booking has built a strong position in vacation rentals and can benefit from this trend. Fourth, they have opportunities to expand into adjacent services like rental cars, restaurant reservations through OpenTable, and experiences. These additional services increase the value they capture from each traveler. The market is skeptical for a few reasons. Competition is intense. Airbnb has built a strong brand in vacation rentals. Google is investing heavily in travel search and could disintermediate the online travel agencies. Hotels are trying to drive more direct bookings to avoid paying commissions. Some investors worry that Booking's commission model is threatened by these competitive dynamics. I think these concerns are overblown. Yes, competition is intense. It always has been, but Booking has maintained market leadership through multiple competitive cycles. They have the scale, the data, and the relationships to compete successfully. Google has been in travel search for years and has not killed the online travel agencies. Travelers still value the comprehensive selection and reviews that platforms like Booking provide. Hotels have been trying to drive direct bookings for decades with limited success. Most travelers prefer the convenience of shopping across multiple hotels on a single platform. Here is my valuation case. Booking will generate around $22 billion in revenue this year, growing at high single digits annually as travel normalizes and online penetration increases. Operating margins will expand from around 30% to 35% as they leverage their fixed cost base over higher revenue. That implies operating income growing from around $7 billion today to over $10 billion within a few years. Apply a 25 times multiple, which is reasonable for a capital-light, high-margin, market-leading business. That gets you to a market cap of $250 billion. Current market cap is around $140 billion. That is nearly 80% upside. And the downside is protected by the quality of the business and the cash flow generation. Even in a recession where travel demand falls, Booking would still generate substantial free cash flow. The business has proven resilient through multiple downturns, including the pandemic. The risks with Booking are primarily competitive. If Google or Airbnb or someone else finds a way to disintermediate the platform, the business could suffer. If hotels become more successful at driving direct bookings, commission rates could compress. If a recession hits and travel demand falls, revenue would decline. If new regulations restrict the business model, margins could be pressured. These are real risks. But I believe the quality of the business and the valuation provide enough cushion. At 18 times earnings, the market is not giving Booking credit for growth or competitive advantages. That conservatism creates opportunity. Let me spend more time on the competitive dynamics, because this is the main bear case against Booking. Google has been trying to capture more of the travel search and booking market for years. They show hotel results directly in search. They allow booking through Google. They have Google Travel, which aggregates options. The fear is that Google will use their dominant position in search to keep users on Google rather than sending them to Booking or other online travel agencies. This is a real threat. Google controls the front door to the internet. If they want to keep travel users on their platform, they have leverage. But Google has had this capability for years, and Booking is still the market leader. Why? Because most travelers do not want to book travel through Google. They want to shop across multiple hotels, compare reviews, see detailed photos and amenities, understand cancellation policies. Booking provides a superior experience for this comparison shopping. Google is great for initial research and discovery. Travelers use Google to search for hotels in a destination, but then they often click through to Booking or another OTA to actually book. Google makes money from the click-through, so they are not highly incentivized to prevent that behavior. They earn advertising revenue, whether the booking happens on Google or on Booking. For Google to seriously threaten Booking, they would need to build a much better booking experience and convince hotels to give Google comparable or better rates than they give to Booking. Hotels are reluctant to do this because they do not want to be more dependent on Google. They already pay Google billions for search advertising. They do not want Google to also control their bookings and take commission. This dynamic has created a stable equilibrium where Google sends traffic to Booking and Booking provides the booking experience. I do not see that changing dramatically. Airbnb is the other major competitive threat. Airbnb pioneered the vacation rental market and built a strong brand. They have over 7 million listings globally, but Booking has responded aggressively. They have built their own vacation rental inventory to over 7 million listings as well. They have integrated vacation rentals into the Booking.com platform alongside hotels. They are using their massive customer base and traffic to drive bookings for vacation rentals. In many markets, Booking now has more vacation rental listings than Airbnb, and Booking has advantages that Airbnb does not. They can cross-sell to hotel customers. They have better distribution in international markets. They have relationships with traditional property managers and rental companies that trust Booking's brand. Vacation rentals are growing, and Booking is participating in that growth, not being disrupted by it. The hotel direct booking threat is something hotels have been talking about for 20 years. Every hotel chain invests in their website and loyalty program to drive direct bookings. They offer incentives like bonus points or discounts for booking direct. Sophisticated travelers know they can sometimes get better deals or perks by booking directly. But despite decades of effort and billions in investment, hotels have not been able to shift bookings significantly away from OTAs. The reason is simple. Most travelers shop across multiple hotel brands. They do not have loyalty to a single chain. They want to compare options. Booking provides that comparison in one place. For Booking to lose significant share to Hotel Direct, every hotel would need to offer rates that are much better than the rates on Booking. But hotels rely on Booking to fill rooms, especially during low demand periods. They cannot afford to cut Booking off. This creates a prisoner's dilemma where individual hotels cannot shift away from OTAs without losing bookings to competitors who stay on the platform. I have studied the relationship between hotels and OTAs extensively. I have talked to hotel executives and property owners. The consistent message is that while they would prefer direct bookings to avoid commission, they need the OTA channel for distribution and demand generation. Smaller independent hotels especially rely on Booking to reach travelers. They do not have the brand recognition or marketing budgets to drive direct bookings effectively. Even large chains use Booking to fill incremental inventory. This interdependence has existed for 2 decades and will likely continue. Commission rates have been relatively stable over that period. Booking typically takes 10 to 15% of the booking value. This has not compressed materially despite hotels' efforts to drive direct. I do not expect dramatic change going forward. Now let me talk more about the margin expansion opportunity at Booking. The company generated about 30% operating margins last year. That is good, but below where I think they can get to. Booking has significant fixed costs in technology, marketing, and customer service. As revenue grows, those fixed costs get spread over a larger base. The incremental margin on additional bookings is very high, probably in the 50 to 60% range. So as revenue grows from travel recovery and market share gains, operating margins should expand. I believe Booking can reach 35% operating margins or higher over the next few years. That 5 percentage point margin expansion on 20 to 25 billion in revenue is over 1 billion in additional operating income. At a 25 times multiple, that margin expansion alone is worth 25 billion in market cap, nearly 20% of the current value. And this assumes no revenue growth, just margin improvement. In reality, revenue will also grow, compounding the earnings growth. Booking also has significant opportunity in ancillary services that are currently under-monetized. They are building out restaurant reservations through OpenTable. They are expanding into rental cars and ground transportation. They are adding experiences and activities that travelers can book. They are testing insurance and other travel-related services. Each of these adjacencies adds revenue and increases the value they capture from each traveler. The customer acquisition cost has already been paid. The traveler is already on the platform booking a hotel. Selling them additional services is high margin, incremental revenue. If Booking can add even $50 to $100 in ancillary revenue per customer, that adds billions to total revenue at very high margins. This optionality is not reflected in the current valuation. The alternative accommodation opportunity also deserves more discussion. Vacation rentals are growing faster than traditional hotels for several reasons. Families and groups prefer the space and amenities of a full home versus hotel rooms. Vacation rentals often provide better value for longer stays. They offer unique experiences in residential neighborhoods versus commercial hotel areas. Work from anywhere trends have increased demand for vacation rentals where people can stay for weeks or months. Booking has recognized this trend and invested heavily in building vacation rental inventory. They have over 7 million listings now. They are integrating rentals seamlessly into the platform. A traveler searching for accommodations sees both hotels and vacation rentals and can choose based on their needs. This integrated approach is an advantage over Airbnb, which only offers vacation rentals. Booking can serve all customer segments, while Airbnb serves only the vacation rental segment. As the vacation rental market grows, Booking's revenue mix will shift toward rentals. This is actually positive for the business model. Vacation rentals typically generate higher commission rates than hotels, often 15 to 20% versus 10 to 15% for hotels. The higher commission reflects the additional services Booking provides for vacation rentals, including guest communication, cleaning coordination, and property management support. So the shift toward vacation rentals should be margin accretive, not dilutive. Booking gets a larger percentage of each booking while still providing value to property owners through distribution and management tools. Let me also address Booking's capital allocation because this is an important part of the investment case. Booking generates enormous free cash flow, over $5 billion annually. They have very low capital requirements because they do not own real estate or take inventory risk. The cash flow is discretionary and can be returned to shareholders or reinvested in growth. Historically, Booking has returned most of the cash through share buybacks. They have bought back tens of billions of dollars of stock over the years. This has reduced share count significantly and increased earnings per share. I expect this capital allocation to continue. As long as the stock trades at reasonable valuations, buybacks create value for shareholders. And if they identify acquisition opportunities that make strategic sense, they have the balance sheet to pursue them. This disciplined capital allocation adds to the investment appeal. Now let me talk about what makes these three stocks different from typical value stocks or typical growth stocks. A typical value stock is cheap for a reason. The business is in decline, the industry is dying, management is bad. Investors have given up on growth and are just valuing the company on current earnings or liquidation value. You can make money in value stocks if the situation turns around or if you buy so cheaply that even modest performance generates returns. But most value stocks stay cheap because the problems are real and persistent. A typical growth stock is expensive. Investors have recognized the growth potential and bid the stock up to reflect years of future growth already. You can make money in growth stocks if the growth exceeds expectations or if the market underestimates how long the growth can continue. But you are paying up and you have no margin of safety. If growth disappoints even slightly, the stock can fall dramatically because the valuation was stretched. Growth at value is different. These businesses are growing, the fundamentals are strong, the competitive positions are solid, but for some reason, temporary or structural, the market is not pricing in the growth. Maybe the market is focused on near-term challenges. Maybe the company is out of favor. Maybe macro concerns are overwhelming company specifics. Maybe investors do not understand the business model. Whatever the reason, you are getting growth at a value multiple. This gives you asymmetric risk reward. If the growth materializes, you get multiple expansion on top of earnings growth. The stock can compound at very high rates. If the growth disappoints, you are protected by the valuation. The stock was not expensive, so it does not have far to fall. Let me give you historical examples of this pattern. When I invested in Chipotle in 2016, it was growth at value. Chipotle had grown from a single restaurant to over 2,000 locations with excellent unit economics and a strong brand. But they were dealing with food safety issues. The stock had fallen from over $700 to under $400. The market was valuing Chipotle as a mature restaurant company with limited growth, but I believe they could fix the food safety problems, regain customer trust, and continue growing. That is exactly what happened. The stock went from under $400 to over $2,000 because the market started pricing in growth again. I bought growth at a value price and earned returns from both earnings growth and multiple expansion. When Warren Buffett invested in Apple, that was growth at value. Apple was growing iPhone sales, expanding services revenue, and generating enormous free cash flow. But the market thought the iPhone was a mature product that would stop growing. The stock traded at around 10 times earnings. Buffett recognized that Apple had a powerful ecosystem that would drive long-term growth and loyalty. He bought growth at a value price. The stock has compounded at high rates ever since, driven by both earnings growth and multiple expansion from 10 times to over 30 times earnings. These examples show the power of finding genuine growth mispriced as value. You get paid twice from the underlying business improvement and from the market recognizing that improvement. Now, let me address how to evaluate whether a stock is truly growth at value or just a value trap. This is critical because most cheap stocks are cheap for good reason. You need to distinguish between temporary challenges that will resolve and permanent impairments that will persist. Here are the questions I ask. First, what is the source of growth? Is it real and sustainable, or is it financial engineering and unsustainable trends? Real growth comes from unit expansion, market share gains, price increases, new products, or market expansion. Financial engineering is cost cuts, buybacks, or accounting tricks. I want real growth. Second, what is the competitive position? Does the company have genuine advantages that will allow them to sustain growth, or are they vulnerable to competition? I want businesses with moats, network effects, economies of scale, brand power, switching costs, regulatory protection, something that makes the business defensible. Third, what is the management quality? Are they capable of executing the growth plan, or will they make mistakes? I want proven managers with track records of success. Fourth, what is causing the valuation disconnect? Why is the market not pricing in the growth? If I cannot identify a specific temporary reason, I get suspicious. Maybe the market knows something I do not. But if I can identify why the market is mispricing the stock, and I believe that reason is temporary, I have conviction. Fifth, what is the downside? If I am wrong about the growth, what is the stock worth just on current earnings? I want situations where even if growth disappoints, I do not lose much money because the valuation was not stretched. Applying this framework to my three stocks, Meta is growing from AI and Reels monetization. They have unmatched competitive advantages in social media. Mark Zuckerberg is a proven builder. The market is mispricing them because of concerns about regulation, competition, and metaverse spending. The downside is protected by massive cash flow generation. Alibaba is growing from cloud expansion and international e-commerce. They have dominant market positions in China. Management has executed well historically. The market is mispricing them because of China risk. The downside is protected by asset value and cash flow. Booking is growing from travel, recovery, and online penetration. They have network effects and scale advantages. Management has navigated multiple cycles successfully. The market is mispricing them because of competition concerns. The downside is protected by the quality of the business model and cash generation. All three meet my criteria for growth at value. They are not value traps where the cheapness reflects terminal decline. They are not growth stocks where you are paying up and praying. They are genuine growth businesses available at reasonable or cheap prices. That combination, when you find it, is incredibly powerful. Now, let me talk about position sizing and portfolio construction with these ideas. I would not put equal weight in all three. I would size based on conviction and risk. Meta is a U.S. company with strong fundamentals, and the main risk is regulatory, which I view as manageable. I would make this a larger position, maybe 15 to 20% of a portfolio. Alibaba has China risk, which is harder to quantify and control. I would make this a smaller position, maybe 5 to 10%. Booking is between the two in terms of risk profile. Strong business, but competitive concerns, maybe 10 to 15%. This sizing reflects conviction adjusted for risk. You want your highest conviction, lowest risk ideas to be your largest positions. Ideas with more uncertainty should be smaller. I would also think about correlation. All three of these businesses are consumer-facing and depend on economic growth. In a severe recession, all three would likely be hurt. That correlated risk means I might not want all three at full size simultaneously. Maybe I start with Meta as the highest conviction idea, add Booking if I can find it at a good price, add Alibaba opportunistically if China risk perceptions improve and the valuation becomes even more compelling. The point is to be thoughtful about how the positions work together, not just evaluate them in isolation. Let me also talk about catalysts and time horizon. These are not one-year trades. I am looking at 3 to 5 year holding periods for these ideas. The catalysts are not specific events, but rather the market gradually recognizing the growth that I see. For Meta, the catalyst is AI products driving user engagement and monetization. For Alibaba, the catalyst is normalization of China risk perceptions and continued strong execution. For Booking, the catalyst is travel recovery and margin expansion. These are all multi-year stories. You need patience. The stocks will be volatile. There will be periods where they go down or go nowhere. But if the fundamentals play out as I expect, the stocks will eventually reflect the value. I want to address one more important point. These ideas could all be wrong. I could be missing risks or overestimating growth or misunderstanding the competitive dynamics. Investing is probabilistic. You make the best judgments you can based on available information, and you accept that some percentage of your ideas will not work. That is why position sizing matters. That is why you do not put everything in one idea, no matter how convinced you are. I have been wildly wrong before. I thought Valiant was a great growth story, and it turned out to be a fraud. I thought Herbalife was a pyramid scheme, and the stock went up. I thought JC Penney could be turned around, and it could not. Every investor makes mistakes. The key is to size positions so that when you are wrong, the damage is limited. And when you are right, the gains are meaningful. With these three growth at value ideas, I am making calculated bets. I have done extensive research. I have conviction based on that research, but I am also humble about what I do not know. I could be wrong about Meta's ability to monetize AI. I could be wrong about China risk being manageable. I could be wrong about Booking's competitive position. If I am wrong, I will lose money on these positions. But I believe the probability-weighted outcomes are highly favorable. I have better than 50% odds of being right. The upside, if I am right, is substantial. The downside, if I am wrong, is manageable because of the valuations. That risk-reward is what I look for in every investment. Let me close with some perspective on why these opportunities exist. If markets were perfectly efficient, growth at value opportunities would not exist. Stocks would always trade at fair value, reflecting both current earnings and future growth prospects. But markets are not perfectly efficient. They are driven by human emotions and incentives that create mispricings. Fear causes investors to overprice risks. Greed causes them to underprice risks. Short-term performance pressures cause professional investors to focus on the next quarter rather than the next 5 years. Narrative and momentum dominate fundamentals. These inefficiencies create opportunities for patient, analytical investors willing to go against the crowd. Meta is cheap because investors are scared of regulation and focused on metaverse losses. They are missing the AI opportunity and the strength of the core business. Alibaba is cheap because investors are terrified of China and extrapolating worst-case scenarios. They are missing the asset value and the resilience of the business model. Booking is cheap because investors are worried about competition and not giving credit for the recovery in travel. They are missing the durability of the competitive advantage and the operating leverage. These mispricings will not last forever. As the feared scenarios fail to materialize and the positive scenarios start to play out, valuations will adjust, the stocks will re-rate higher. That is when you make money. The question is whether you have the patience and conviction to hold through the volatility and the doubt. Most investors do not. They buy when things look good and sell when things look bad. They trade based on sentiment rather than fundamentals. That behavior is what creates the opportunities. If you can do the opposite, if you can buy when others are fearful and hold when others doubt, you can generate extraordinary returns. These three stocks, Meta, Alibaba, and Booking, represent that opportunity today. They are not perfect. They have risks. But they are genuine growth businesses trading at value prices. If you do your own research and reach similar conclusions, if you have the conviction to act and the patience to hold, these could be exceptional investments over the next several years. That is my thesis. Now you need to decide whether you agree.